my net deferred, overall, my net temporary differences are 29,500. So that's my gross of taxable less my deductible. So what I've done there is I've netted the two off and come up with a single number for a deferred tax liability. Now I'll tell you what that assumes. That assumes two things. First of all, we've got a legal right of set-off, and secondly, that it's the same country. Because imagine that you've got some transactions and assets in Malaysia, but you've also got some assets and transactions in Singapore. And what you would not necessarily be able to do is to offset a deferred tax asset in Singapore and therefore use that to reduce your tax liability in Malaysia. So the assumption is that we're all in the same country. The assumption is that we are able to legally offset these items. So offset or net, yeah? This assumes a legal right to net settlement. This assumes a legal right to net settlement and the same tax authority. 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 Secondly, I'm using the rate of 30%. Yeah, because 30% was given in the question. But in theory, what is that 30%? Let's imagine you're given two rates. Let's imagine you're given this year's rate, and the current rate is 30%. But let's imagine you're told that next year we're going to be a larger company, and we will have to pay tax at 35%. Or that next year the government has already announced and substantially enacted a rise in taxation rates. So we know that this year we pay tax at 30%, but next year we'll pay tax at 35%. And both numbers are given to you. We are trying to provide for a deferred taxation liability. Would you provide at the current rate of 30 or the future rate of 35? 35, yeah. Because you're trying to work out a deferred tax liability, so you should use the rate of tax at which you are going to think you're going to be paying the liability. Now normally that will simply be the current rate, because normally you don't know what the future rate is going to be. But if you're moving to a small, medium-sized, different band, if the government has substantially enacted what the tax rates are going to be in the future, then you could use that tax rate. So the tax rate that we are looking to use, is the rate expected to be paid. Yeah? So use the tax rate expected at the date of payment. Yeah? So in other words, use the future rate. We're creating a liability. Yeah? We are creating a liability. So yeah, it's at what rate are you going to have to pay the tax? Right, I've almost finished with deferred tax. Let me have a look at the time. Yeah, I've almost finished with deferred tax. It's probably going to take me about 20 minutes, 25 minutes to finish off with deferred tax. So instead of breaking at 11, we shall be breaking shortly after 11. But when we break, we will have then finished deferred tax. So there's 3 or 4 little things that I just want to cover, just to kind of mix it up a little bit. Yeah. So offset, it's possible. It's what you would assume. Yeah. But if you start to be told that there's no right of offset, or you start to be told they're in different countries, then start separating out those temporary differences. Tax rate, you would just use the rate you are given. But if you're asked to explain it, it is effectively what you think the future rate is going to be. Right, a couple of things, losses carried forward. So a few more little tricks, a few more little issues, losses carried forward. Let's imagine you're looking at a business which has got a loss of 200. Let's imagine the jurisdiction has a tax rate of 20%. Let me give you three alternatives. Alternative one, tax charge is nil. Nil, just put nil there, loss will be 200. Alternative number two, charge an expense of 40. Yeah, charge an expense of 40. Make the loss, therefore, 240. Scenario number three, give them the tax relief. Put a credit there of 40 and have a loss after tax of 160. All three are technically possible, but what is the most likely scenario if you've got a loss of 240? Is the most likely scenario 1, nil, 2, which is a tax charge, or 3, which is a tax credit? Tax credit, scenario number 3. The most likely scenario is that you have, loss, that you have this credit, that you have the loss relief. Did I not say that accounting for deferred tax was about the matching concept? If you report the profit this year, you report the tax on the profit this year. If you report the loss this year, you report the loss relief this year, even if you're not getting that loss. Now I'm talking about losses which are carried forward. So losses which are carried forward are a deductible temporary difference. Because losses carried forward have already been acknowledged in the financial statements, but have yet to be given a tax relief for taxation purposes. So they create a deductible temporary differences. Losses carried forward are a deductible temporary difference. Losses carried forward are a deductible temporary difference. They are recognised in P&L, they are recognised in the financial statements, they are recognised in the financial statements, but not yet for tax purposes. So they don't have a taxation base. They are recognised in the financial statements, but not yet for taxation purposes. So 200 times 20% gives you 40. So you debit your deferred tax asset by 40, and you credit your profit and loss account tax by 40. Or do you? Yes, I think you do. Yeah, if you've got losses carried forward, then you recognise that that loss carried forward is a deductible temporary difference, and recognise that creates a deferred tax asset. But, how do you get the tax relief? What has to happen in the future before you recover this asset? Not cash. What do you have to do next year or the year after to benefit from the carry forward of your losses? You have to make a profit. Okay? Are you going to make a profit next year? Yeah, I'm not sure either. I'm not sure either. I would need to understand a little bit more about why you made a loss this year. If you made a loss this year because you were sued, if you made a loss this year because of a one-off transaction, if you made a loss this year just because it was a bad year, there was an unfortunate event, then okay, the underlying profits will take you through to next year. But if you've made a loss last year, the year before, the year before, the year before, if you've got a background of making losses, so you're carrying your losses forward, I don't think it's reasonable to assume that you are going to recover that deferred tax asset, because it's not reasonable to assume you're going to make profits in the future. So what we need to do is to be sensible, prudent. This is almost P7. If you were an auditor, you would be very suspicious of a deferred tax asset in a company which was making losses. It ought to be writing that asset off. That asset can only be there if you believe, if you assess that it is probable there's going to be future profits. And that's a judgment issue, so you'd always have to be given clues, or it will be a discussion point in the question. Note, in order to recover the deferred tax asset / losses carried forward, there will need to be sufficient taxable profits. In order to recover the deferred tax asset, the losses carried forward, there will need to be sufficient taxable profits. Therefore, only if these taxable profits in the future are assessed as probable, is the asset recognized? Is the asset recognized? So only if these taxable profits in the future are assessed as probable is the asset recognized. Okay, so losses carried forward, a little bit controversial, yeah. Does create a deferred tax asset, but can you really recover that asset? So only if these taxable profits in the future are assessed as being probable is the asset recognized. Otherwise you'd write it off. Only if these taxable profits in the future are assessed as being probable is the asset recognized. If there's any doubt as to whether or not you're going to make a profit next year, then I think you should write the asset off as irrecoverable. This is my favourite point about deferred tax. And I know it's nearly 11 o'clock, but I don't want to rush it. I want to enjoy this moment. Because for some of you, a light bulb might come on. And I believe the framework is very important, and very important potentially also for your December exam. The framework is principles. The framework is ideas. The framework is asset and liability orientated. The framework is the future. The framework influences financial reporting standards. The framework gives us an ability to criticize standards. So if we see a conflict between the framework and the standard, it's a discussion point. And it's sad, really, because in an ideal world, the principles, the framework, have influenced the standards so much that the standards therefore are consistent with their foundation and consistent with the definition of assets and liabilities. Now, we've already seen leases. We've already seen ISA 17. We've already seen how an operating lease, we've already seen how a 3-year operating lease, no asset, no liability. If you account for the standard, ISA 17, a 3-year operating lease, expense, expense, expense. But if you take the framework, under the framework, the definition of a liability is met. Under the framework, you should recognize a liability because there's a past event and you have got a present obligation to make those 3 payments, and there is an asset because you have the right to use and control the asset for 3 years. This is what we've done before. This is what we do again on revision. The first thing to say is when you have a conflict between the standard and the framework, follow the standard. Conflict between the framework